How to invest like Warren Buffett. Have you ever thought about investing in stocks but hesitated because of financial crises and market crashes? There's a smart way to invest without risking everything. Intelligent investing. It's a method introduced by Benjamin Graham in 1949, emphasizing a long-term, low-risk approach. Many, including Warren Buffett, have successfully used this strategy. On this episode, based on Graham's advice, you'll discover why ignoring short-term market fluctuations is crucial, why starting with virtual money is wise, and why sometimes the cheapest stocks are the most valuable. Lesson number 1. Intelligent investors don't rush in. They take time to rationally examine a company's long-term value. Investing can be both lucrative and risky. History has stories of successful investors like Warren Buffett, but also of those who lost everything. Is it worth the risk? Yes, if you follow intelligent investing. Intelligent investors focus on thorough analysis for safe, steady returns, unlike speculators who gamble on short-term market changes. Speculating is unpredictable, as it relies on rumors and market fluctuations. Intelligent investors prioritize pricing, buying stocks below their intrinsic value based on a company's growth potential. It's like shopping, paying for quality with a margin of safety. The goal isn't excitement, it's profit. Lesson number 2. Intelligent investing is broken down into 3 principles. Intelligent investors follow 3 key principles. 1. Analyze for the long term. Before investing, study a company's long-term performance, financial structure, management quality, and dividend history. Look beyond short-term earnings and focus on the company's overall financial history. A less popular company with consistent profits may be undervalued and a wise investment. 2. Diversify investments. Protect against significant losses by spreading investments across different stocks. Avoid putting all your money into a single promising stock, as unforeseen events can lead to sudden value loss. Diversification safeguards against losing everything at once. 3. Prioritize safe and steady returns. Intelligent investors aim for stable, reliable returns rather than chasing extraordinary profits. The goal is to meet personal needs, not to outperform professional stockbrokers. Avoid the pitfalls of greed and recklessness associated with seeking fast money. Lesson number 3. Intelligent investors understand the importance of stock market history. Before diving into a stock's history, it's crucial to examine the broader history of the stock market. Historical trends show regular market ups and downs, often unpredictable. Be financially and psychologically prepared for economic crises, understanding that market recovery follows even the most severe crashes. Ensure a diverse stock portfolio to minimize the impact of market hits on your investments. Resist the urge to sell everything at the first sign of trouble, as markets eventually rebound. After confirming market stability, focus on the company's history. Analyze the correlation between its stock price, earnings, and dividends over the past decade. Consider the inflation rate to evaluate your actual earnings. A 7% return may sound good, but if inflation is at 4%, your real return is only 3%. Historical knowledge is a powerful tool for savvy trading, so keep it sharp. Lesson number 4. Don't trust the crowd or the market. To grasp the market's behavior, imagine it as a person named Mr. Market, unpredictable, moody, and easily influenced. Mr. Market swings between unwarranted optimism and unjustified pessimism, reacting to events like a new iPhone release. Prices rise during excitement, leading to overpayment. The intelligent investor avoids following Mr. Market's mood swings and stays realistic. Just because the market is optimistic doesn't guarantee sustained profits. Stocks performing well can lose value due to inflated demand. Despite knowing this, The temptation of short-term gains is strong. We're wired to recognize patterns, even when none exist. Seeing profits rise, we convince ourselves of a continuing pattern. Understanding these principles sets the foundation for intelligent investing. Subsequent insights will provide practical tips tailored to your unique investment style. Lesson number 5. The defensive investor's portfolio should be well-balanced, safe, and very easy to manage. When starting your investment journey, choose a strategy that suits you. If you're risk-averse, consider the defensive investor approach. 1. Diversify safely. Split your investments about 50-50 between high-grade bonds and common stocks. For the more risk-averse, a 75% bonds and 25% stocks split works. 2. Diversify stock portfolio. Invest in established companies with a track record of success. Aim for at least 10 different companies to minimize risk. Simplify choices by mimicking well-established investment funds portfolios. 3. Seek expert advice. Utilize the expertise of professionals to guide your investment decisions. They understand the game better and can help you make informed choices. By following these principles, your cautious approach will likely yield positive results over time. Lesson number 6. Investing is easy when you follow the formula. After selecting your investment companies, congratulate yourself as most of the work is done. Now, implement formula investing or dollar-cost averaging. Determine a fixed amount like $50 to invest regularly in your chosen stocks, ensuring consistency. Set your investments on autopilot, buying as many stocks as your fixed amount allows. This approach prevents overinvesting and reduces the risk of impulsive decisions. While formula investing minimizes effort, periodically check your portfolio's performance, adjusting the division between common stocks and bonds every 6 months. Ensure your stocks remain profitable and the ratio aligns with your initial investment plan. Consult with a professional once a year for advice on fund adjustments. With these principles, you're equipped to start as a defensive investor, and subsequent insights will guide enterprising investors towards success. Lesson number 7. Enterprising investors start similarly to defensive investors. To succeed as an enterprising investor, employ similar strategies as defensive investors. Divide your funds between bonds and common stocks, but lean more toward stocks for higher profitability despite higher risk. Collaborate with a financial planner as a partner, not just a teacher. In addition to traditional investments, enterprising investors explore higher risk, higher reward stocks like potential breakthrough startups. However, limit these to a maximum of 10% of your overall portfolio to manage risk. Despite exciting opportunities, impose limits to safeguard against market unpredictability. Like defensive investors, enterprising ones recognize the importance of ongoing research and portfolio monitoring for sustained profitability. Lesson number 8. The enterprising investor doesn't follow the market's ups and downs. Investors often engage in market trading, fearing financial losses if they go against the flow. However, intelligent investors take a different approach. Trusting Mr. Market, the market's unpredictable nature, can be risky. Rapidly climbing stock prices may indicate overvaluation or a risky investment. The U.S. housing bubble serves as a cautionary example. Enterprising investors aim to buy in low markets and sell in high markets. Regularly assess your portfolio, evaluating management and financial situations. If a company's stock prices grow without reflecting its true value, consider selling before a potential crash. Conversely, seize opportunities to buy in low markets. For instance, Yahoo made a wise move in 2002 by purchasing Inktomi Corp. at $1.65 per share during a market downturn. This strategic buy exemplifies the principle of intelligent investing. Lesson number 9. The enterprising investor has the chance to find real bargains. Becoming an enterprising investor may seem challenging, but the effort pays off, especially when you identify the best bargains. To start smart, consider virtually tracking and picking stocks for 1 year before diving into real investments. Numerous websites offer virtual investment platforms for this purpose, allowing you to hone your skills and manage expectations. After your virtual experience, focus on hunting for bargains in undervalued company stocks. The market often undervalues stocks of temporarily unpopular or economically struggling companies. For instance, if a solid company like Enterprise B faces a temporary setback, causing its stock price to drop, an intelligent investor sees this as a buying opportunity. Identifying bargains can be tricky, emphasizing the importance of practicing in the virtual world first. If you can succeed there, you're better equipped to navigate the real-life challenges of enterprising investing. So, in summary, whether you prefer a defensive or entrepreneurial approach to stocks, the key is to walk the path of the intelligent investor. By following the guidelines outlined in this video, you can transform your investments into modest yet steady profits. Thank you for watching. Don't forget to like, comment, and subscribe. Watch more videos by clicking on this video right over here.